You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast.
Welcome back, everybody. Welcome back, Brandon. How are you doing on day 24 of your 24 video advent calendar? How are you doing?
I'm still alive.
Still cracking on.
I'm here. I'm kicking. I got a... I wanted to get all of my videos done as soon as possible because yesterday I got a message from the old Tesla Motors saying that my vehicle was ready for a pickup. So yesterday I went and took delivery of my brand new white Model 3.
Oh, you got it. Wow.
I got it, boy. I got it.
That is so good. That's such a good
I actually
Christmas present.
flippin' got it.
That is the best Christmas present you will have in
Merry Christmas
years.
to me.
That's fantastic. Did you go and drive it around for a while?
Yeah, I went to drive it around. See, I'm going to get a full paint protection film put over the whole thing and like ceramic coating and stuff. So I've been talking to the guys that do that, the detailers, and they're like, yeah, drive it around, but please don't try and drive it too much. Just please avoid any situations where there might be any rock chips or anything. So I'm just like real cautious. But I actually, when I was talking to him, I asked him because I was like, should I just try and just imagine I haven't gotten it yet before I take it to you guys to get it protected? And he was like, look, dude, you got a new car. You're gonna drive it. But just don't be stupid, I guess, is what he was saying.
Yeah.
But,
when are you getting it wrapped?
I have to take it to them on the 30th.
Right.
And then apparently they have it because I'm doing a full body wrap. Click like just paint protection film. It's not actually like a colored wrap or anything. Yeah. And apparently they'll have it for like a little over a week or something as they work on it. So they must be really busy or something.
Well, that's not too bad. You've only got to survive a week without driving on stones and doing burnouts or something.
Doing burnouts. But then the problem is that then I have to go without it for a week. I'm going to get myself addicted and then have to give it up for a week.
Yeah. It's going to be a struggle.
No, I can say it is blowing my mind. It is just unbelievable. This vehicle is just insane. And I'm, going down the highway and I've got autopilot on and it's just something else. It is just something else. It is so bizarre the first time you actually do it. I'm enjoying it.
Yeah, I've never seen. Oh, I have seen it. That's not true. I've seen a Tesla in person, but I haven't like been inside one. I haven't driven one for sure, and I haven't been in a passenger in one at all. So, next time we connect, you'll have to. take me
I'm
for
coming down to Melbourne in mid-January.
Right.
So I don't know. Are you around in mid-January?
Yeah, probably will be. Yeah.
All right. Cool. Well, we'll do something there. I'll drive down, so that'll be good.
Yeah. Awesome.
And we can go for a little bash. All right. Anyway, welcome back to the podcast. Here, this is well and truly just become the Tesla podcast today.
Yeah, we actually do have a little bit of Tesla news.
Yeah, exactly. I was just going to say the same thing. We actually do have some stuff to talk about. So should we get cracking?
Yes. So today's episode is sponsored by Sharesight. So Sharesight is an application you can use to track the performance of your stock portfolio, and it will allow you to keep track of all of the different types of gains you experience when you're investing in the stock market. So currency gains, dividends. If you have dividend reinvestment plans, then it will do all of those calculations for you. Currency gains, if you're buying shares internationally or you hold foreign currencies, which is something that most people don't track, and it's super, super important. And then the main reason why I personally use it and have been using it for the past 3.5 years is when it comes to tax time. So Sharesight generates up to 10 different reports that can be used at tax time to easily work out things such as your capital gains, your dividend income, and more. And at the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. You can use that link to sign up to a free plan and use it for as long as you want. Try it for as long as you want. But if you want to sign up for more features, more tax features and reporting and that sort of thing, you can get 4 months free when you sign up to a yearly subscription if you use that link, sharesight.com/young investors. So go check it out.
Go check it out. Hey, I realized this episode's going to be coming out on Boxing Day. So why don't we start off with this news story about Boxing Day? Did you know that shoppers are set to spend a record $2.75 billion across Australia on Boxing Day? How insane is that? That's a lot of money.
That is.
And to be honest, that surprises me that they're predicting it's going to be a record, particularly after the year that we've had, like 2.75 billion across Australia on Boxing Day. But I don't know, there's an appetite for spending, clearly. How we were debating whether people were going to even resume their spending habits near normal, like maybe 6 months ago we were debating that just after all the shutdown and whatnot, but it seems like predictions are in. I mean, I think Black Friday in Australia was also very good. Actually, I should just read this because I think it talks about it. So it says Australians are predicted to spend a record $2.75 billion across stores nationwide this Boxing Day, according to the National Retail Association. The retail lobby group is forecasting shoppers to splurge record amounts again on Boxing Day after spending more than $2.59 billion at the shops on the same day last year, right? Okay.
Right.
The NRA also predicts the nation's online spend will hit $930 million on the day after a highly successful Black Friday sales earlier this year and a total spend of $649 million on Boxing Day last year. Okay, I thought it was going to say what Black Friday was, but it doesn't.
Yeah.
But yeah, interesting. What's your take, Hamish? I'm quite surprised actually that we're so willing to spend after I thought that 2020 crippled people, but clearly not.
Yeah, that's exactly what I was thinking. I very much thought that there would be a decrease in retail spending, in consumer spending in general in 2020 because of the pandemic. But clearly that hasn't been the case. This isn't the first thing. I read something this morning and I didn't add it as a story, but IKEA Australia had record sales this year.
Okay.
It's a private business, but they do report sales. So they had record sales this year. So this isn't kind of, one day out of the year that looks like it's going to be better than last year. It's been a consistent trend, particularly as the lockdown has kind of opened up. So it's, I don't know what else to say besides the fact that I'm extremely surprised that, the pandemic didn't have a typical impact on people, at least yet so far, in terms of spending.
Gosh, I hope the worst isn't yet to come. That'd be a worry. But you never know. I mean, are any stimulus packages still going on in Australia? Have we still got JobKeeper and JobSeeker and all that? I don't know.
Yeah, I think
that's maybe starting to be phased out.
Yeah, I'm pretty sure they're all still in place. They're still certainly at lower levels than they were previously, but that's starting to sort of get phased out. But yeah, I guess it just depends how consumers react and how businesses react over the next year or so. If consumer spending's down, then businesses make less, then businesses lay off people. And if they lay off people, those people spend less. And then it can become quite a rapid cycle quite quickly, as we've seen in some really bad recessions. But that seems to be yet to be seen. So, yeah.
Also, I want to go back to what you were saying before. What's that? So IKEA is a private company, yet they report sales. I find that really interesting.
Yeah.
Wouldn't it just... I don't know. Do you know why that is?
No, I don't actually.
Oh, okay. Because I would have thought that like if you're a private business, you just want to keep all your cards close into your chest, right?
Yeah, the article did say that they made some filing that revealed it. So
maybe there is still something.
Yeah, I don't think we get access to like all their financial statements or anything like that. They would have to voluntarily produce that, which, as you said, would probably be not good for the company. But there may be some level of public reporting that's required by really
somewhere
large...
Somewhere along the line.
Yeah. That's just required by really large private businesses. But very interesting.
Interesting. What should we talk about next? I don't think we've got anything else to add to talking about Boxing Day. Yeah. Other than remember, if the sticker price is $1,000 and You only spend $500 for the TV. Then remember, you didn't save $500, you spent $500. That's the only thing I say when you see all these massive sales.
Yeah.
Because they're so tricky. They really do trick people sometimes.
Yeah, they do.
I guess that's the aim, right? The aim is to trick people into buying things that they don't necessarily need.
That's true.
Otherwise, sales just wouldn't be a thing, right? Because people would only buy something if they needed it.
Yeah, the whole idea of a sale is it's just a marketing thing.
Definitely.
There's no recommended retail price for most products. So to say that it's 30% off is very, very misleading.
Yeah, it's totally not. I mean, that you're never going to put it this way. A business is never going to do a sale where they lose. So they're always going to make money. Like, you'd have to be stupid if you did a sale where you actually ended up losing money. I mean, worst, you'd break even, but you'd always try and make money even in a sale. So when it says it's like 50% off, they're still making money off that. So you got to always ask yourself, well, if you're making money off that, how much did this thing actually cost you?
Yeah, definitely.
It's like a clothing, some fashion brand or something. 80% off was 1,000, now down to 200 or whatever. And it's just like, yeah, well, if you can do that sort of discount, how much did that, t-shirt or how much did that dress or whatever it is actually cost you?
Yeah. Or at the very least, if they are discounting something beyond their cost, then it's kind of a way that the business gets people in the door to spend on other things. You see that a lot on Boxing Day, where a store will have a discount on certain items. Maybe it'll be just a discount rack, but then everything else is just regular priced or 5% off or something. And that's where they're making their money. But yeah.
They always, no matter what the deal is, they always end up on top, right? The retailers, they're never, overall, the whole experience, they're never losing money.
Yeah, exactly.
Yeah. Anyway, what should we talk about next?
Let's talk about this Qantas news, and then we'll get then we'll jump into Tesla, because we'll build up.
We need to space out the Tesla.
Yeah, exactly. We can't just go straight head first into Tesla, or else this podcast will be over. But yeah, so I almost said Tesla. So Qantas is seeking ACCC approval for a partnership with Japan Airlines. This is one of their bigger moves that they're making now that the airline space in Australia is looking a little bit stronger for Qantas.
Yeah.
So basically what happened was yesterday, Qantas announced that they want to partner with Japan Airlines, and that partnership would essentially allow them to coordinate schedules, airfares, so pricing the flights, and then share revenue on flights between Australia and Japan starting in next year. So they want to have some kind of deal here. And because this deal gives Qantas and Japan Airlines such huge market share, which I'll talk about in just a second, they need to seek approval for this partnership. They can't just go ahead and do it. So basically, they're seeking approval from the government body that regulates this, the Australia Competition and Consumer Commission. And the reason why is because the deal would give the partnership 70% market share for that route. So 70% of flights and 70% of revenue generated from flights between Australia and Japan would be controlled by Qantas, the Qantas and Japan Airlines partnership. So to break that down, Qantas and Jetstar in 2019 had 60% market share. So Qantas and Jetstar being a budget airline as a subsidiary of Qantas, for those who don't know, they already had a lot of market share. They had 60%, which is kind of astounding. And Japan Airlines had 10%. So they'd be adding that 10% and controlling that altogether.
Right. Okay. So I'm straight. Do you understand what they're trying to actually do? So are they is like Qantas trying to, I don't know, pay out Japan Airlines for their, I don't understand what they're trying to do.
Yeah. So basically, the biggest concern here is that it will allow Qantas and Japan Airlines to price gouge the popular routes, so to increase prices. So instead of competing against each other and Qantas, raising their prices, but then Japan Airlines being cheaper, so Qantas has to lower theirs a little bit to be competitive. Instead of that, the two CEOs just call each other up and say, hey, let's raise our prices by 30%.
Oh, so I see. So yeah, right. So they're coordinating their two businesses to align with each other.
Correct. Yes. So
Yeah,
that's
okay.
the major concern, is that then 70% of the market is controlled by these two businesses that are now working together, and that can raise prices. And I mean, if most Australians, 70% fly to a lot of countries around the world, but particularly Japan is a really popular one at the moment, flying with Qantas. So that's the major concern.
Of holidays.
Yeah, exactly. I mean, obviously this is anecdotal, but I just know personally a lot of people going to Japan or having interest in going to Japan. Just in the past couple of years, it's kind of been a popular thing that I've seen anecdotally.
Lots of people skiing in Japan. That's quite common.
Yeah, exactly right. So basically Qantas is arguing, so obviously they are arguing against the fact that they're going to price gouge, but they're arguing that there are still other competing airlines. There's another one whose name I forget, which had 8% market share.
Right.
So they're arguing that there's other competing airlines, and that also that Virgin Australia could very well start a route in that industry and take some market share. So that's Qantas's argument is, hey, we do have 70% market share, but there's other competition. It's not the only option to fly with Qantas, Jetstar, or Japan Airlines.
Yeah, that's interesting. The question I have is, why would Qantas bother? I mean, if Qantas and Jetstar had 60% market share in 2019, Japan Airlines only had 10%. Is it really that necessary that they need to, be bestest buddies and handshake, that, Japan Airlines and Qantas and Jetstar are all going to keep things on the level playing field with each other into the future? I would have thought that, I don't know, maybe I'm missing something, but it's just like, man, Qantas and Jetstar, they had such big market share. Or maybe all these other ones are trying to undercut Qantas and Jetstar. So Qantas and Jetstar are just trying to get in and prevent that from happening potentially.
Yeah, the way that I would imagine this going, and maybe this is wrong, but I would imagine that the revenue split would probably be fairly similar between the businesses if they were separate. The difference is that they can then coordinate schedules and the prices. So while Qantas in the end still may collect around 60% of the industry's revenue, and Japan Airlines may still collect 10% of the industry revenue may go up because they're able to work together and rather than competing. That would be my
that makes sense.
That would be my imagination. But you're correct in that they already had 60%, so it's not a dramatic increase. It's not like they're going from 30 to 60, which would be really scary, I guess, for some people, where you have an industry, if the biggest was 30 and then you had a 10 and an 8 and then a few others, going to 70. That's a big change. So it's a small change, but
so maybe next week we'll see Qantas is seeking ACCC approval for partnership with that airline that has the next 8% of market share. Yeah, and then what will that drag them up to? 78%. And then the next one that has 7% market share.
Qantas seeks approval to take over the entire industry.
Yeah, all of a sudden, all these different airlines have shaken hands and are just going to double the price of flying between Australia and Japan. There you go.
Yeah.
No, but that's interesting. I'd be interested to look into that a little bit more closely and explore the finite details, because it's a bit of a weird one. I've not seen something like, I can't really remember a good example of when something like that's happened. Can you think of an example, like off the top of your head, where something? I'm sure it's happened many times, like these kind of industry partnerships, but I just can't think of anything right now.
Yeah, I can't think of anything that's like a good comparison.
Let us know if you have a good example of how something that might be similar. But anything else to say on that one?
No, I mean, the only other thing is that approval takes 6 months. So this is not, the story's not going anywhere anytime soon. And the reason why they executed it now or started the process is because Qantas's international travel is expected to resume in 6 months. So that's the timeline. So now they've started the motions in making this deal happen.
Makes sense. All right, well, let's move on into the next news story. All right, we better cover this Apple Tesla news because, man, it's been dominating my feed recently. I don't know about you.
Oh, no.
The headline I've written down, or that I've pinched here, is that Apple was approached by Tesla during the Model 3 program struggles, Elon Musk says, but Tim Cook blew off the meeting, which is very interesting. So it says, in a tweet, Mr. Musk said he reached out to Apple chief executive Tim Cook to discuss the possibility of Apple acquiring Tesla for 1/10 of the current value, and Tim Cook refused to take the meeting. How insane is that?
The tweet was pretty funny. when he said for 1/10 of the current value. It's such a slap in the face.
I know. The slap in the face is he refused to take the meeting. It's like, cop that, Tim. But it's very interesting because it says here, Tesla's market value is currently 616 billion. And 1/10 of that is obviously 61.6 billion. So just dramatically different numbers. But it's very interesting that, Apple didn't want a bar of it. And back in that time where Elon and Tesla were trying to ramp the Model 3 production, they've admitted that they were only a few weeks away from a potential bankruptcy with the issues that they had getting their lines getting the Model 3 ramp up and running with the lines, the general assembly lines. That's when they built that. You remember when they built that tent?
Yes.
And they started building cars through the tent. Yeah, it's unbelievable.
Yeah, it's crazy. It's so funny that this comes out now because that was right around the time when we were discussing who would acquire Tesla or who would make a good fit for that. And I remember saying it's very on brand, Apple and Tesla. Yeah. And when they were sitting at around a $50 billion, or at least less, the price was less than the amount of cash that Apple had, it looked like a really good, to me, it looked perfect. It looked like Apple and Tesla's brand is so smooth. And it was within price range for Apple, who probably were looking or should have been, I think, should be looking to spend some of that cash to move into a new market. But they can't really do that anymore unless they're going to sell for way under the current market price.
Yeah. I've seen a couple of funny memes out of this story. It's just like, imagine if Apple bought Tesla. It'd be like if you bought a Tesla, engine and wheels sold separately.
Yeah, I saw that one.
You saw that? What's another one that I saw? I can't remember. That was a really funny one. Oh yeah, geez. The other meme was, imagine if Apple bought Tesla. Every year that you owned your Tesla, your car would get progressively slower.
In like the third year, it just suddenly dies. Like, no, right outside of warranty.
Oh no, dear, oh dear, critical malfunction. Oh no, looks like you have to buy a new one. Oh dear. But I've actually, to be honest, I've said the second half of the story before the first half of the story, because the whole reason that this tweet from Elon actually came out is because there's been some mad speculation lately that Apple are getting back into the electric car game because, of course, I'll just read it here. This is a Reuters exclusive saying Apple Inc. is moving forward with self-driving car technology and is targeting a 2024 release date for, to produce a passenger vehicle that could include its own breakthrough battery technology. People familiar with the matter told Reuters. The iPhone maker's automotive efforts, known as Project Titan, have proceeded unevenly since 2014, when it first started to design its own vehicle from scratch. At one point, Apple drew back the effort to focus on software and reassessed its goals. But Doug Field, an Apple veteran who had worked at Tesla, returned to oversee the project in 2018 and laid off 190 people from the team in 2019. Since then, Apple has progressed enough that it now aims to build a vehicle for consumers. Two people familiar with the effort said, asking not to be named because Apple's plans are not public. So there you go. So, I mean, there's nothing official out of Apple, obviously, and this is just a Reuters article from two people apparently close to the matter. But that's the whole reason that Elon even tweeted that, because, all of this stuff reemerged that Apple's back in the game, going to make their own electric passenger vehicles. So, yeah, I don't know. 2024, apparently revolutionary battery technology. I mean, I've seen a couple of memes about that as well, that, the Apple executives just watched Tesla's battery day and and said that they're going to do the same thing or something like that.
The one thing that Apple does have over Tesla, I guess they still do have this over Tesla, is money. They have a lot of money.
Oh, yeah.
Which
can't argue that one.
I mean, and money's not everything, but it does give a significant advantage. The only thing I'm worried about is if their cars are as unreliable as their phones, then I won't be getting in one. So
yeah, that's I don't know. Everybody does talk very highly of Apple products, but the Apple products I've owned have really had some reliability issues. Yep. And I'm talking laptops, phones, I think that they're the only products that I've used of Apple's.
Yeah,
but
my laptop died. My Mac died just a couple of weeks ago. I don't know a single person who's bought an iPhone in the last 3 years who hasn't had a replacement.
yeah, it's I don't know, but obviously that's the other thing that the Apple has going for it, and that is a very loyal fan base that just buys whatever the hell they come up with. You can argue that obviously Tesla's got some sort of brand moat, but potentially on the same level as Tesla's brand moat, or even bigger, is Apple's brand moat.
Yeah.
I mean, Apple has a really loyal following, and you think about the potential synergies that could be brought in if, this is all, at the end of the day, all the things that we're talking about are just technology, phones, laptops, now electric cars, etc. You just think how many people have Apple, an iPhone, they have a MacBook, maybe they have what's the home speaker thing from Apple? I can't remember. Maybe they've got one of those
HomePod or something. Yeah.
HomePod, yeah, and then all of a sudden they bring out this new car which has got some sort of integrated functionality with all those different other Apple products, and all of a sudden for an Apple user it becomes quite a draw card,
Yeah.
That's going back to that ecosystem that they've built because of that brand. So there's a bit of a switching moat in there as well. So yeah, I find that very interesting. I will be very interested to see, because obviously Tesla is just all about innovation. Apple once was about innovation, but over the past little while, unfortunately, I would have to say under most of Tim Cook's reign, they've focused less and less on innovation.
Yeah.
So I'd be interested to see if Apple do come out with an electric car, how does it compare to Tesla? Not even the maybe the latest generation Teslas, but how does it relate to the Teslas that came out 3, 4, 5 years ago when they were just ramping up their first iteration of, say, the Model 3 or something like that?
Yeah, that is going to be very, very interesting. I
kind of hope they do it.
Yeah, I mean, I really do hope they do it. If it's anything like the smartphone industry, they'll have older technology, but they'll be able to market it in a way that's attractive, like they do with their phones. But yeah, it's going to be fascinating. Yeah, you're right about Tim Cook. Certainly, he leans more on squeezing efficiency out of what they've already got versus innovating new products and leading the charge. So yeah,
definitely.
We'll see. Maybe a change is coming in Apple.
Maybe. Who knows? Who knows? I would really like to see it. If only just to see more electric cars out there.
Yeah, definitely.
That's got to be a positive. And plus, if you're just a consumer, right now there's really no one that can compete with Tesla in the electric car space. Like, yes, there are other options out there, but in terms of quality and in range and all that sort of stuff, no one really competes with Tesla. So I would be really interested to see more competition, because as a consumer, you always want to see, it's kind of weird. As an investor, you want to see less competition. You want your company to have a monopoly. As a consumer, you want a lot of competition. So there's a lot of options out there, and the competition drives the innovation. So I want to see it, just if it means more people get electric cars and we push further towards sustainable transport.
Yeah.
And ultimately that's Tesla's mission. That says on the front page of anything they release, Tesla's mission is to advance the transition to sustainable energy. So this has got to be a good thing. Any way you look at it.
Absolutely. Next 5 years is going to be very, in 5 years time, it's the electric car industry is going to look very, very different from what it looks like today. And I'm excited for it.
I hope it does. Yeah.
Yeah.
I hope it does. But anyway, I think that's probably all we got to say on that one. Anything else?
No.
We've yarned on about it for quite a while. What should we do next? You want to do this other news story about Google?
Oh, yes. So in my second piece of ACCC news for today, so Google is also seeking ACCC approval, but in this case, it's for their acquisition of FitBit. So Google agreed to buy FitBit last month for $2.1 billion. And
did we cover that? I can't remember.
I don't think we did.
But I remember us talking about it might happen. So there you go. It's actually happening. Man, I just completely missed that one.
Yeah, me too. Yeah, we must have spoken about it a few months ago when it was when they made a bid for them or something like that. I can't remember exactly. But I think so. Last month they finally agreed to do it. But first, of course, they need to get approval from every government before they do anything because they're under great scrutiny at the moment.
Yeah.
But basically, the move would allow Google to do two key things. One, of course, is that obviously they gain some competitive ground in the fitness watch industry. But the other thing that's significant is that they would get access to wristwatch data from 27 million Fitbit users, which could, of course, be, in theory, used in advertising. Google is all about how much data they can collect and use to improve the advertising space for businesses online. So that, to me, is probably the more significant play here. The fitness watch industry, it's big, but it's not crazy compared to Google's size, but to improve advertising efficiency by a small amount can make them a lot of money. So basically, Google entered into a court-ordered, what's called an undertaking, which would basically say Google agrees that the court is forcing them to only use the data in a certain way. So basically, Google's saying, hey, you can decide. You can decide how we can use this data. If we can't use it for this, that's fine. But let's set up a deal so that we can do this acquisition with some limitations, if that makes sense. And basically, the ACCC just rejected this. They said no.
Oh, okay.
They said that's not going to happen, which is different to what the European Union did when Google offered this deal. The European Union said yes. They said, yeah, we'll come up with some parameters for how you can use the wristwatch data, and we'll let you go through with the acquisition. But in Australia, the ACCC is continuing to investigate, and that's just ongoing at the moment. So we don't really know how that's going to turn out. But considering the current conflicts between Australia and Google in terms of the news media and a bunch of other things going on with Google at the moment and Facebook, I think it's unlikely that this will go well for Google. And the other thing is that if they do not, if they just go against the ACCC, they face a $400 million fine. So it's not going to be cheap if they don't wait for approval.
Although Google will probably be like, they'll just do the economics. Is it worth the fine if we go straight away? Is it worth it if we get the revenue earlier? But this is interesting. To be honest, I find it quite interesting that the ACCC has any say in the matter when we're talking about Google and Fitbit. But I guess it's just whatever happens in Australia, right? Whatever they decide to do in Australia. Because they're two American companies, right?
I guess it's really complicated, right? Because they're just two American companies. The Fitbit's just a physical product, but the consequence, I guess, is that they can use Australians' data to make more money in other ways.
Yeah, it's interesting.
So it is very confusing. A lot of these kind of fights, I guess, I guess that we're seeing at the moment between companies and governments, they're really complicated, and no one really knows what's right. How's the right way to go? Yeah.
Because obviously, when I just look at this, I'm just thinking Google, Fitbit, acquisition, two American companies, sure, it'll happen.
Fine.
And it's like, wait, what? The Australian, what is it? Consumer and what is the ACCC? Australian
Competition and Consumer Commission.
Competition and Consumer Commission. They actually have a say in the matter. They're like, actually, hold up, guys. But that's interesting. But I want to go back to the point that you made before about the whole point of this is potentially just for data, just to get more data. And I think that's an important point to touch on. It's something that gets overlooked by people that are looking at these massive companies that we see around the world that make, hardware or, run websites or whatever, apps, that a lot of people, they would look at an iPhone maker and they'd be like, they make a they'd look at an Apple or something. Oh, they make iPhones, and just think, oh, they're just like a hardware company. But a lot of these businesses, like one of the highest priorities for their business is to collect data. It's like data is money, really, in today's society. So it's like even like, you know, Apple's, Google's, Facebook's, but even companies like Tesla. These companies, yes, they make products and they provide services, but at the end of the day, one of their highest priorities is to gather data.
Yeah.
It's like data is the new currency almost.
Yeah. We spoke
we
spoke about Facebook last week and how they had this innocent looking app that was free. You could download and it helped you to manage how much data usage you had in apps. And now it's people think that they possibly used that data to stifle competition, to buy WhatsApp, to buy Instagram when they were coming up. So it's interesting. You just download an app and you don't even think about it. But what the company is actually gaining from that is significant data. It's just, it's a whole different side of things that I think a lot of people don't consider.
Yeah, exactly. Like some of the highest priorities, although they would never say this, some of the highest priorities for companies are figuring out how humans think and what humans do and their behaviors and what triggers them to perform certain behaviors. Because if they can figure that out, then that is a real money-making tool. Like forget, we sell pixels, or we sell iPhones, or we sell, you know, cars or whatever. If they can figure out it, at the end of the day, we want to collect data about how we do things, what we think, because that unlocks everything else. That unlocks advertising algorithms, that unlocks the key to, you know, full self-driving, that unlocks the key to, you know, everything really. So I don't know. It's very interesting. Something that I'm interested in, I suppose.
Yeah.
That sometimes a lot of people don't think about. They kind of just see companies at face value, but their actual motivations are much deeper.
Exactly right.
Yeah, interesting.
All right. We've got to talk about this.
Oh my, holy moly. What this is one of those news stories where you see it and you're just like, this is ridiculous. But it's so ridiculous, I have to learn more about it. So listen to this, and I'm interested. You'll probably be as shocked, viewers at home, listeners at home, you'll probably be as shocked as I was when I first read this. KFC confirms the release of the KFC console as a rival to the PlayStation 5 and the Xbox Series X. That is a sentence I never thought that I would ever say. So this is really weird because I'll read what the article said. Fans could not believe it was actually real, but KFC is claiming its latest game-changing product really does exist. When KFC teased fans back in July with a video promoting a KFC gaming console, complete with a chicken chamber, many people presumed it was just a clever marketing stunt, but the fast food giant has now surprised everyone, claiming the product is indeed real, and that you can't fry your chicken inside the console, but you can keep your pre-cooked KFC warm while you are gaming. However, KFC hasn't announced any information on how or where gamers can get their hands on them. In a tweet on Tuesday, the official KFC gaming Twitter account revealed that it's the KF console. I'm just going to call it the KFC console. They revealed that the KFC console is real and it is not a hoax. Hamish, what the hell?
That's just dumb. This is what happens. This is what happens when a company takes their April Fool's marketing joke too far.
Yeah, I reckon. Well, that's what I'm thinking is like, has April Fool's shifted to like late December?
Yeah, we moved it.
But this is the thing, right? Is that even though the accounts have come out and said, no, this is a real thing, everybody still doesn't believe it. It's like there's going to be no amount of confirmation from KFC that this is real for people to actually believe it because it's just too ridiculous. I think the only thing that is going to make people believe it is maybe actually buying it,
Yeah,
actually being able to buy it or see it in a store or something like that. But I don't like, this is messing with my head.
Yeah.
I mean, is this just a clever marketing stunt? Because now that I've said all that, the verified accounts are saying that it's real, but I'm like, am I just falling for some massive joke? Like, is this actually real?
Yeah. I mean, I'm just having I don't know, my brain's just stopped working because I have so many questions.
Yeah.
Like what? Like how would that even, surely it can't be. This can't be real. There's no way this is real. How would it even work? Do you put PlayStation discs in it?
Well,
Do you have to does the game have to come out on that console as well? Do you put computer games in there? Does it have, maybe it has Steam
to be
on
honest, I think what people are speculating is if this is real, then it's not really going to be a gaming console. It's just going to be like a high-end PC. So I think that it's really just going to be like a computer. So it'll probably run like PC games.
Yeah.
I would imagine.
Like
because
Steam on there
there's no way that, CD Projekt Red are going to, start working on Cyberpunk 2077 for KFC console.
Oh God, give them another 8 years.
Yeah, exactly right. Yeah. So I don't know, but this is just so bizarre. It says KFC is known for pulling marketing stunts, including hyping fans up about a KFC chicken computer keyboard and a chicken drumstick mouse. Other stunts include KFC fried chicken scented sunscreen, KFC nail polish that tastes like fried chicken, and KFC Crocs shoes. And in 2019, KFC released a real game called I Love You, Colonel Sanders. It's a dating simulator game. So,
dude, I love this. Can I work in this marketing department?
Sounds fun, doesn't it?
Sounds so good. What are we going to make today, guys? Chicken drumstick mouse. Get cracking.
Yeah. But I mean, the fact that they have done all those weird things in the past just makes me super skeptical. Like, I have no idea, but obviously we don't have any specs or anything. So I don't know. I'd probably lean on the side that this is still a hoax and isn't real, even though it's been confirmed by KFC to be real. I don't know. I just feel like this is one massive troll. But if it is a troll, then it's flipping genius because look at what's happening. We're talking about it on a podcast.
We just did a sponsored segment that's longer than our actual sponsor. Hang on a second.
Exactly
Sharesight.
Right.
Go sign up. It's better than KFC. Don't buy KFC.
It's bad for you. It clogs your arteries.
Yeah, it's real bad.
But there you go. I mean, if it is just marketing, then credit to them because everyone's now talking about this stupid thing. So
yeah, I'll believe it when I can buy one, and if I can buy one,
true.
I'm gonna buy one, and then I'll let you know how
really?
it goes.
You're gonna buy one?
Well, if it's real, how could you not?
I tell you what. You probably make back your money if you just made one YouTube video about the KFC console.
Exactly right. And if they're limited in number, I'm sure I'll be able to sell it for more afterwards.
Exactly.
So
it'd be a collector's item. Just hold it for like 100 years. Yeah. Sell it one day. I doubt KFC's going anywhere in the next 100 years.
Yeah. Put my chicken in there. It's gonna be great.
Exactly right. It'll be warm. It'll stay warm.
Just so dumb.
Anyway. Gosh. But tell us what you think. Do you reckon this is real or do you reckon this is just an absolute hoax?
No.
Let us know on the YouTube version of the podcast. So I'm interested to hear what you guys have to say. Surely it can't be.
It can't be. Maybe they'll make 5 of it. I don't know.
Yeah, who knows? It's like ultra exclusive. Anyway, all right. Shall we move on to do some Q&A? We got a couple of Q&A questions today. Yeah. How about I hit you with this one here?
Sure.
Hey, Brandon and Hamish, big fan of the podcast. In your next Q&A, can you explain how, if possible, to do a discounted cash flow calculation on a stock that has a negative earnings per share? The stock I'm looking at currently has a trailing 12-month EPS of negative 71 cents, which screws the calculation for the 10-year EPS figure. Yeah, because obviously if you grew that, it would get more and more negative.
Yeah.
Is there a way around this? I think we spoke about this a little bit last week when we did that Q&A podcast, which is strangely coming out next week.
True. That's right. Yes, we actually haven't. Yeah, so this will come out first. No, I mean, yes. So obviously you can't just use a growth rate because that won't take you anywhere.
It'll take you more negative.
Yeah. So in theory, right, you could project that a company goes from its current negative profits or cash flows, as I like to use, to becoming profitable at some point in the next 10 years. So what you could do is you could manually model out each of the next 10 years. And if it's negative, what did you say, 70 cents now, maybe next year's negative 50 cents, and then it gets positive at some point in the future. So in theory, yes, you could do it. You just couldn't use a growth rate. You'd have to manually plot out what the cash flows would be over the next 10 years and then beyond. In practice, it's not something that I try and do because I like companies that have a 10-year proven track record of profitability, because it just reduces a ton of uncertainty. A lot of unprofitable companies remain unprofitable. Some companies get profitable for a couple of years, or they do really well for a couple of years and then they go back to performing really poorly. It's very rare that a business builds some kind of product or service or some kind of something unique in the market that it allows sustainable and large profits. So I like to see that first. Yeah.
Yeah, I don't have anything to add. I'd agree. Yeah, you just have to go back to your own analysis of where you think they're going, and like what you say, just plot it out and go from there. All right, should we do one more?
Yeah, we can do.
Geez, this is a long one.
You want me to do this long one?
Yeah, sure.
All right, I'll read this one to you. B&H, have been enjoying your podcast, so please continue the good work. Thank you very much. I appreciate that.
Yeah, cheers.
As long-term investors, has there been a scenario where one would take a stake in an undervalued company, but years and years down the road, the market still never sees its true value and the share price does not reflect it? What if the company continues to make good metrics, earnings, no debt, strong management, Moat, etc., but the share price does not rise? If one would hold on to such company, would one still benefit and have a worthy return on such investment in the form of buybacks, dividends, or anything else? Or does the market always find value in a good company and the share price will be reflected? I'm just trying to understand what returns other than the share price increase should one keep in mind when thinking long term. Sorry if this question is too long, blah, 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 blah. No, it's a really good question though for a long
it is
one.
a good question. The way I see it, I mean, the stock market, there can be some weird stuff that happens. So there is the potential that maybe you invest in this company when it's undervalued and, give it a few years and it's still undervalued and investors haven't really woken up to it. But I wouldn't particularly worry if you've made a good investment and it's undervalued, and the company metrics, like the earnings are still growing, the cash flows are still growing, they don't have any debt, strong management team. If the business is still performing, then I just keep holding it. I mean, I think the key thing here is to make sure when you first buy. This is why we first buy when it's at a discount to intrinsic value, so that there's even a potential in the stock price just rising back up to its intrinsic value, in which case we can still make money. But overall, I'm sure it's happened before where there's been an undervalued company that has just performed well but also stayed undervalued. It might have something to do with the general market conditions at the time as well. But generally speaking, I mean, at the end of the day, investors around the world, we're trying to put our money into companies that are growing so that when we buy the shares at a certain price, in 10 years, the shares are worth more. So generally speaking, if a company is growing, people are going to find it, and money will be sunk into it. Because there are a lot of companies where money gets sunk into them and they're not growing or they're going backwards. So if that's happening, then surely there will be a company that, if it's growing well, all things look good, then eventually people will find it and it will start gaining more and more traction. Because, I mean, at the end of the day too, if it's growing consistently and growing well, I mean, if it keeps growing, eventually it will become, a larger and a larger and a larger and a larger company. So eventually it will just pull people's attention towards it just by the fact that it's a company that's getting much larger. So that's something else to consider, I guess. Yeah. Sorry. What do you have to say?
No, I think
on
that's a pretty good answer. I think, I mean, if a company is a really good business and its stock price is staying undervalued for a really long time and it has a good management team, then that's like the perfect combination, because it means that the management team can just spend all of their free cash, or a significant amount of it, leftover profits, excess profits, whatever you want to call it, on buying back stock and increasing value for shareholders. And sometimes that might not happen in a company for a very long time. And I mean, there will be certainly situations where you think a company is worth something and it doesn't go to that price even over a very long time. It's going to happen. You're not going to have a perfect track record of picking businesses. But I think it's the way that I think about returns is not just in the stock price. I think of it in terms of the total amount of excess cash that's left over. If that cash is kept in the business, it should be reflected in the stock price over the long term. And if it's distributed out of the business, it comes back to you in the form of dividends. So
true.
That's pretty much all I had to say on that.
Yeah. Very good. Thanks for the questions, guys. We appreciate it. And of course, if you do have a question, if you want us to cover something for not next week's podcast, because we've already recorded that one, because we're going to go on holidays for about a week. But if you have any more questions that we can include in future podcasts, then head over to the YouTube version of the podcast and let us know in the comments section below. Just type into Google the Young Investors Podcast, find the most recent upload, and then leave your comment, your question, your discussion topic in the comment section there. And we look forward to doing much more Q&A next year. But that is just about it. This is Boxing Day, so enjoy the cricket today if you're watching, and hope you guys had a very Merry Christmas.
Yes.
We're recording this on Christmas Eve.
How
nice. What do you got planned for Christmas, Hamish? You doing much?
Just catching up with the family. Nothing too crazy. How about yourself?
Nice, good stuff. Exactly the same. Just catching
Beautiful.
up with the family and maybe taking them for a spin in the Tesla.
Oh yeah. You'll be the favorite one this year.
Oh yeah, favorite child. Get around me, everybody. Oh dear. Anyway, but no, thank you guys very much, and again, thanks for all your support during the year as well. We've really appreciated you guys and the time you've given the podcast, and showing up every week and listening to what we have to say, I guess. So we appreciate it. Thanks very much for the support during the year, guys, and enjoy the Q&A podcast next week, and we will see you in 2021.
Woohoo. See you later, guys.